Okay. Okay. Right. Okay. Hang on. Right. Can everybody hear me now? You can't hear me now. Anybody hear me now? Can anybody hear me now? Now, okay. All right. Okay. Okay. We fixed it. We fixed it. Brilliant. Excellent. We can hear now. Great. Great. First of all, let's start again. Big apologies, ladies and gents. Yes, it's okay now. Brilliant. We can hear now. Okay, cool. Right, let's start again. So first of all, big apologies, everybody, for the technical issue we had there. I've done over 250 broadcasts now. That's the first time that's happened on a live broadcast. But anyway, let's start again. A very good morning to everybody and a very happy Thursday. Today's program, we're going to discuss the FOMC minutes, what was discovered in that, plus discuss the blame game happening in the UK at the moment. But before we get into all of that, don't forget, these little videos are for educational purposes only, and in no way whatsoever should ever be taken as financial advice. So I always suggest you do your own research and do your own diligence, and of course, know the risks at hand before entering any trade. With that out of the way, let's get started properly this time. Okay, excellent. It's all working now. Brilliant. Thank you, Michael. And thank you, everybody, actually. Thank you for chipping in and letting me know. Okay, so yesterday, late last night, we had the FOMC minutes released. And obviously, these are the minutes taken and released 3 weeks after their initial interest rate decision. And basically, what these minutes showed was they are, again, fully committed to the cause of bringing inflation down to 2%. And in fact, they basically said in these minutes is that the cost of doing too little, as in not being aggressive with raising interest rates, outweighs the cost of doing too much. So basically what they're saying is far more risky than not increasing interest rates to what the outcome of the economy could be. It's worth it. It's more important to do that than to what actually will happen with the economy. They also said in the minutes that inflation remains unacceptably high. So the inflation is still extremely high. And they're saying that it's declining more slowly than anticipated. They had hoped for a more dramatic decrease in inflation. So they're disappointed with how inflation is falling back. They said the job market remains very tight. It's true. We had a pretty good NFP last week, showing that the US labor market is still pretty strong, and they will keep raising rates. But and this is one thing which did give obviously the market a little bit of hope, but not enough. They did mention in the minutes at some point, they will slow down the pace of interest rate hikes. They will slow down the pace. They also said in these minutes, and this is important as well, so it gives any idea that we might have an interest rate decrease anytime soon in the future or sometime next year. They said they will maintain rates at a high level for some time, so they'll keep interest rates high, and until there's compelling evidence that inflation was on course to return to 2%. Now, don't forget, we've got the big inflation reading today, which we'll talk a little bit more about in a minute. But inflation is, on the last reading, was at 8.3%. That is pretty far away from the 2% target. So the fact that it's decreasing really slowly, and we're miles away from the target, means that the Fed is indicating they're willing to keep interest rates high for a very, very long time. Now, because of these minutes, obviously, the now anticipation is that we're actually on for that's a good question, Michael. I'll come to that in a second. Thank you, Michael. That's a really good question. Who do you think will fall into recession first? Great question. I'll come straight to that in 2 seconds. Now, this is the fourth rate hike. Now, anticipation, they're going to do a fourth rate hike of 75 basic points. Don't forget, the last 3 interest rate decisions, they've all been 75, 75, 75. So now, obviously, based on these minutes, and based on what's going to happen today, which I'll talk about in a minute, is the anticipation they will do another 75 basic point rate hike. And in fact, they are saying it's 92% chance. This is what the market is anticipating, a 92% chance of 75 basic point rate hike in November. However, all that can change. That could change quite dramatically, because today Today, up next is we got a real big one, a real potential massive market event. And that, of course, is the US CPI, Consumer Price Index, due at 12:30 p.m. UTC. UTC. And because it's so big, or potentially could be such a big event, of course, we'll be doing a tixee Live watch along at 12:20 p.m. UTC. Okay, so please come along for that. Now, in my personal opinion, the anticipation for it for the inflation rate is coming at 8.1. Anything above 8.1, between 8.3 and above or higher, I can see potentially pressure coming on the market. Anything below 8.1, then maybe we might see a bit of a bounce in the market. But according to the FOMC minutes, I don't think even if we get a low reading on inflation, bear in mind we're still at 2%, it's not going to change the Fed's attitude to rates in any way whatsoever. But now, anyway, I want to go on to that great question I got from Michael here. And it's a great question because it moves me on to my next topic I want to talk about quite some detail. And his question is, well, who do you think will fall into recession first? And obviously, I'm going to compare the UK, the EU, and America and the United States. In my personal opinion, and I think they're almost there already, the very first economy which is going to fall into recession is going to be the United Kingdom, followed then by the EU, and then down the line, maybe early part of next year, it'd be the US. I definitely think the UK is on its way to recession. It's on the edge right now. And I feel it's going to fall into recession certainly before the end of the year. So my answer to the question would be the UK, then the EU because of the energy crisis, and then later down the line, United States because the Fed is driving the economy that way, which leads me straight onto my next story, which of course is the sterling. What we're talking about in the UK is the sterling. Now, the sterling at the moment is holding its breath over the next 48 hours because don't forget, the BOE is set to end its emergency package or bond buying package tomorrow. And they said they're committed to ending it. Now, here's the thing. The market is steady at the moment because they not quite sure how the market's going to react next week when this bond buying program stops. Tomorrow's the last day. And because there is so much uncertainty on this, there's the blame game is beginning to start. The blame game. Now, those of you who've watched me in the past, they know that I've often talked about the Bank of England and the UK government trying to get the UK out of this current mess. This financial crisis is brinkling on. It's the only way to do that is to work together. They're not working together. They are not working together. In fact, they're blaming each other now. The UK Chancellor of the Exchequer has said the Bank of England will be responsible if the market suffers next week. They've all putting on the Bank of England. It's Bank of England's fault. That's what basically they're saying. Kwasi Kwarteng, when he was asked about what will happen next week and his feelings, and he said, and who's responsible, he said it's the matter for the governor. Basically what they're doing is they're basically prepping, UK government is basically prepping to make the Bank of England governor, Andrew Bailey, the scapegoat. The scapegoat. That's what they are doing. They're setting him up to say that when it happens next week, even though it's their mini budget, which really kickstarted this, it's not the overall reason for it, but it kickstarted it, they're blaming him. They're getting ready to put all the blame on him. And this is not good because you don't need the UK government and the Bank of England at odds. You need them right now working together to increase stability. Can the Bank of England change their minds and push the bond buying program back? Yes, they could, but then they lose credibility. Nobody will believe a word they say. So this is the danger they are in. And I really do feel for Andrew Bailey. He's made a rock for his own back for saying what he said the other day, but now he's really in a tough spot. So anyway, let's have a quick look at the sterling, see where it is at the moment. At the moment, unsurprisingly, it's fairly range bound at the moment. It's trading just above that 1.10607 level, which is a potential area of interest. And as I expect it to be a little bit sideways today unless we get more developments from the Bank of England, more pressure on the UK gilt market. I expect it to be a little sideways today, currently trading maybe just below the 1.11 mark, or just around that area until we get that CPI reading. That's what I anticipate. I really do. If we have a look at the euro sterling as well, let's have a quick look at where the euro sterling's doing as well. Okay, as you can see, again, very sideways. And obviously, it's waiting to see what happens with the CPI. But really, this pair is waiting to see what happens next week when that bond buying program finishes. So there we are, currently trading at 0.8749. While we're at it, let's have a quick look at the euro as well. Again, pretty range bound at the moment. Currently trading at 0.97173. Why? Because we are, of course, waiting for that CPI, which I anticipate. I really do anticipate it's going to be potentially a massive event, and I'm really excited about it. That's why I'm doing a watch along. Anyway, on another story, more threats from the Bank of Japan. And this is interesting. I'll bring up the dollar yen in a minute. This is interesting. More threats from the Bank of Japan. Finance Minister Suzuki, he says, we cannot tolerate excessive volatility in the currency market driven by speculative moves. We're watching the currency moves with a strong sense of urgency. Now, here's the thing. This is what really piqued my interest in particular. He goes on to say, it is not as if we have a specific level in mind. Instead, we're looking at volatility. So basically what he's saying, last time they intervened 2 weeks ago, they allowed the dollar yen to get up to jump around at 146, and then they jumped in and intervened in the FX market. Now they're saying they haven't got a particular level, because don't forget the dollar bulls have been pushing the dollar yen above that. It's currently trading just below 147. So they're not actually giving a specific level. And these are the levels they intervened at in 1998 last time. And it's like I say, it's a 24-year low for the yen. So they're not telling us an actual level. What they're saying is volatility. So I will certainly be watching this pair, the dollar yen, on the CIP announcement. Because if it's the volatility, and we could see a lot of volatility in the dollar yen, come that CIP announcement, that may spur the Bank of Japan to do something. So that's what they're saying. It's the volatility. It's not the level. It's the volatility. So that could be really interesting to watch. Let's have a quick look at the dollar yen now as we talk about it. Okie dokie. Let's have a quick look. Right, as you can see, we're trading just under that 147 level. Currently trading at 146.81. So I really want to see what happens on the CPI announcement. Because just imagine we get a load of volatility with CPI, and at the same time the BOJ intervenes. Whoa, that would just be madness. That would be madness, but that'd be something really interesting. I'm not saying they're going to intervene, but I'm going to say they are saying, hello, Eric. Hi, buddy. How you doing? Really good to see you. How are you? I hope you're well, and hope your family are well, bud. Are you going to come and join me for the watch along, Eric? Later, it's going to be a good one, I think, potentially. No, in my luck, I'm building it up, and it's going to be really boring. 6.0. Oh, that's the core, you reckon? Yeah, CPI. Oh, what's that, year on year? It's going to be a good event, though, buddy. Definitely come and join me. But like I say, it'd be really interesting, wouldn't it? I don't think they will, because the markets are that'd be just too volatile. A big nasty event, and then a Bank of Japan intervening. No. Anyway, I just wanted to share that story with you. Too. Let's have a quick look at gold as well. Of course, we always talk about gold, because obviously I'll be watching this pair come, obviously the watch along. Currently trading just above that key area, like it has been for a while. This is on a daily, of course. $1,667.86. So that's where we currently are with that. You are later. Oh, brilliant, good man. It's going to be. It could, like I say, it could potentially be really good. But like I said, and then again, it could be, no, in my luck, it could be really boring. Hopefully it won't be. But anyway, gold, pretty flat as well. Like I say, most things waiting for the big CPI, because let's face it, it is the main event today. It really is. And don't forget, the last announcement, last reading back in September the 13th, caused huge volatility in the market. So this could do the same. Really depends on what it comes in. Don't forget, like I say, that is the main event. We do have US retail sales tomorrow. And of course, I will be talking a lot more about this in a lot more detail in the days to come. We have earnings season kicking off really tomorrow with JP Morgan, Wells Fargo, Morgan Stanley, and Citibank all releasing their earnings. European equities as they currently stand, DAX in the red, negative 0.27. DAX currently slightly in the green, 0.19% higher. And US Stoxx 50 currently trading 0.12% higher. 6th of November. Really? They think they would do, you say, my prediction, inflation rate 6.8 in November. They decrease interest rates. Okay. When do you think they're going to start decreasing interest rates? In November? If it comes in, let's face it, if the inflation comes in at 6.8, if that's year on year you're talking about, bear in mind the headline prediction is 8.1. That would be really dramatic. That would be really dramatic. I don't think they would decrease interest rates in November, though. They might do a slight pivot. Maybe, just maybe they might. But I don't know. According to those minutes and what they've been saying, I really think they are truly committed to the cause. Well, what does everybody else think? That's, you know, like I say, nobody knows for sure. Nobody knows for sure, Eric. It could come in. I mean, like I say, last time they expected 8.1 and it came in at 8.3 year on year. Well, that's if you got inflation, you don't increase the. Like I say, this is the idea. If you still, I mean, their target's 2%. So yeah, if you are right, you're absolutely right. It will blow the market. Wow, you know, that would blow my mind as well. It really would. It really would. But like I said, I think again, you know, my feelings about this is that every time we try to, or the market tries to fight the Fed and push back and say, you know, think the Fed's gonna, you know, be lessened. The Fed keeps, you know, telling them, well, that's not the case. We are going to carry on with this goal. We're committed to the cause. We want our inflation to be at our target of 2%. And the Fed keeps proving it wrong. As the old saying goes, don't fight the Fed. Don't fight the Fed. But like Eric, if you are right, my God, that would certainly blow the mind. What does the UK do at the moment? UK don't care about any other. That, do you know, Eric, actually is a really good point. Yesterday afternoon, I did a little piece on that. I did a little piece in my video yesterday. The video called US dollar breaking all our stuff. And I did a little thing where I discussed what Christine Lagarde said. There's a banking conference over there. And she said in a speech that central banks need to start working together. They need to start working together to solve this problem. So they really need to start to work together. So this is the thing. I compared it to what happened in 2009 when Gordon Brown, he was the Prime Minister of the UK at the time, got all the central banks together. And in unison, all together, they agreed to decrease interest rates. And they agreed to do it all at the same time. Okay. Now, central banks do communicate with each other. They do tell each other what to do. Okay. But they need to be working in unison. And like I said yesterday, I don't think, even though we're brinking on the crisis, we're going to get that. You know, because ideally what we do need is the Fed to help the sterling, to help the euro, to help the yen. We need the Fed to start slowing down to help the currencies, but they're not willing to do so. They're not willing to just do so. Because the difference they have is got the UK, like I said, going to fall into recession first. And then you're going to have the EU. The US is not going to fall into recession to maybe the first quarter or the end of the first quarter of 2023. So they're in a different position. So they're happy to carry on. And you're right, decreasing action, the pound goes down. If they decrease it, if they can, the pound is still going to struggle, but it's going to give the pound a little bit of strength. Because don't forget, the UK and Europe, we buy our energies, we pay for our oil and our gas in dollars. It's priced in dollars. So that's going to cost us more. So that's what they need to do. That's a really, really good point. I don't think they will, because the Fed are in a absolute different position. And they are dead set. They're dead set to do what they want to do. And they're not really bothered. They're watching what's going on in the outside world because it does affect them. It will affect them. What happened in the UK, the UK's financial crisis at the moment can affect them. But they still sit to their goals. So we're not going to get the repeat of 2009. And that ideally is what we need, is the central banks to work together and agree to help each other out. But at the moment, we're not going to get that. But that's a really good point, Eric, a really good point. Is there any other questions? Anything else anybody else like to say? No, it's been an interesting program, this one. We got off to a bad start with a technical problem with the sound going. That's the first time in 250 broadcasts I have done that I've had a problem with sound. Very first time on a live broadcast. But luckily, I managed to fix it. So that was quite something. Don't forget, if you think of a question later, you can put it in the comment section, either on Facebook and YouTube. I will see them and I will reply to them next time I go live on air, which of course, as I've already known, I've already said, will be later today at 12:20 p.m. UTC to do a watch along of the US CPI. And I hope you all can come and join me for that, because potentially that could be a massive event. So please come and and join me for that. If there is no other questions, in that case, big shout out to I think Miss Trividi, who notified me about a sound issue. What would be the state of the indices? That's a great question. I was just about to thank you, actually. That was a great question. Say the indices on the CPI, yes? Okay, well, potentially, again, obviously, nobody knows for certain. If we get a hotter than anticipated reading, okay, hotter than reading, so a higher CPI, then we could see the S&P and the NASDAQ and the Dow come under a lot of pressure, like they did on the 13th of September, the last CPI shocker. So it could see a lot of pressure on that, potentially, if we get a hotter than CPI warning. If we get a lower CPI reading, then we could see an initial bounce in the other direction, a bounce higher in the indices, because the market might then start hoping again, which it won't happen, hoping again for a US dollar, a Fed pivot at some point. But that's a really good question. And thank you as well for notifying me about my sound issues. I really, really appreciate that. So anyway, big shout out, like I just said, SMN 790 as well. Thank you for that. You notified me too. Michael as well. And thank you, Michael, for your great question. And thank you, Eric, as always, for all your great questions and interaction. And thank you, all of you, for coming along to join me today and putting up with that little technical problem we had at the beginning of the show, which I really, really, really appreciate. Anyway, till next time, if you're watching me on Facebook and you've liked this little video, by all means, give us a follow. If you're watching me on YouTube and you enjoyed this little video, subscribe if you like. Hit the notification button so you know next time when I'm going live. If you enjoyed this video and found it interesting and useful, by all means, give me one of those. It's nice to know that you like what I do. Anyway, till next time, don't forget, these little videos are for educational purposes only, and in no way whatsoever should be taken as financial advice. I always suggest you do your own research, do your own due diligence, and of course, know the risks to the hand before entering any trade. Till next time, every single one of you, trade safe.